Business Spotlight, brought to you by Cross Rhythms and Baba Baboon.
I'm Sonya Farrall and this is Business Spotlight in partnership with Cross Rhythms City Radio and Baba Baboon. Joining me in the studio this week, we've got expert Matt Fludgate from Gatewood Commercial Finance, who started the business back in 2017. Matt, hello.
Good morning, Sonya. Hello.
How are you?
I'm good, thank you. And you?
I'm good. Well, thank you, Matt, for coming in here on Business Spotlight. Now, commercial finance. I'm not going to lie. I don't know a great deal myself about commercial finance because I've never really delved into it that much. So do you just want to explain, before we go anywhere, what this actually means to a business?
Of course, yeah. I can't say it's as interesting as being a radio presenter, so let's start with that. It's definitely not that interesting. But in a nutshell, probably how people will have touched brokers in the past would probably be with their residential mortgage, when they'll want a new mortgage and they'll go and see somebody who will sort it for them. That's basically what commercial finance is for businesses. So for a whole plethora of products, but realistically, somebody will go to a commercial broker who will source that type of finance in the market for them. The aim being that obviously they'll know what the best product is, who the best people are for that product, saving the business owner time because he hasn't got to hawk around the market, and also saving them money because they'll get the best product quicker. So yeah, in a nutshell, that's what we do.
Now, as a business owner, and I can imagine there's so many different things being a business owner where you're looking to do 1,000,001 things, especially when you're getting started, and even down the line as well. There's still a lot to contend with, I suppose, and a lot to think about. So if you are looking or even considering to finding out more about what commercial finance is and how it can help you, what would be the starting point? Because you can get, I suppose, overwhelmed. So what would be the process to first of all look into it?
Yeah, I think realistically, it's dead easy for someone to say, I need this product. Right, I'm going to go to market. And it could be that there are 30 lenders, 40 lenders out there. How is somebody going to sift through all of that and possibly land up with the wrong one? I'm not going to mention any lenders now, but there's a couple out there who are very good at marketing and they bombard clients. And then suddenly clients come to you a year later and say, I've been put in contact with you. I've seen you. I heard about you. I've got this loan at the minute. And it's like, why are you with them? Your business is so much better. Well, they contacted me. They sent me an email shot every day. They must be okay. Well, actually, that's the wrong market for you. You're in a much better market. Your business is much better. So I think that's the added value that brokers can give, because actually we see businesses all the time. We see accounts all the time, and we've got no affinity to any particular lender. Certainly I don't. I don't care who the lender is. It's about what's the best product for that client. And that sometimes isn't even the product they thought, let alone the lender that they thought. So, yeah, I think it's always good to get a neutral perspective, for want of a better phrase, which is what a broker is there to do, to help the client and work for the client rather than work for the lender who's trying to shift their product onto them.
So can you give an example then if a business for the first time is maybe looking into, commercial finance? What sort of situation, would they be in? What is it they're looking to do?
So it can be anything. I mean, it literally is, it's hard to narrow it down. It could be that they've got, they're looking to buy new equipment. They're looking to buy a van. So, a small business might be for want of a better phrase, a one-man band in construction. He needs a new van. He knows he's going to do a lot of miles in that van, and that's going to cost him £15,000, £20,000. He's never going to be able to put that out the door in day one. So now he's going to go, how can I buy the van and afford it? Well, actually, you can do it over 5 years, 6 years. You can fund it over that. Oh, great. You might have a business who's been going a couple of years. They've grown. That's great. They want to take on new members of staff. We need a new member of staff. I had a client who used finance to fund their wages and said, I know it's going to take 6 months for that member of staff to bring money in. So actually, if I get their first year's wages on a loan over 5 years, I haven't got that pressure. In inverted commas, I'm paying their first year's wage over 5 years, which obviously by a year, they're going to bring money in and that will be great. So there's a whole different load of reasons. And even property. I mean, I don't, residential mortgages is another bag, but even in business, you're looking at, commercial mortgages, you're looking at property developers who are looking to build sites, or, residential buy-to-let landlords who are looking to buy 5, 10, 15, the number can be, exponential on that. So, yeah, it's a whole range of business reasons that people will want finance of a particular ilk, for want of a better phrase.
Yeah, so they say what you just mentioned there, if somebody's like, saying even in construction or, an engineer, a one-man band, and they're getting the work in, they're getting busier and busier. They know they need to expand and bring a team in or another person. But What would be the criteria then for that business? Does it go on the turnover? Does it go on projection? How does it work for them to be successful? Possibly, and I know you can't say someone. Not everyone's the same. But as an example, what would be, what would they need to do?
Best way to describe it is a difference between an investor and a lender. So you look at Dragon's Den and the bit that's always edited out, which is great. Now, I have heard from people who've been on there and know people there that actually the Dragons spend quite a lot of time looking at the accounts and the bank statements before they go in the room. But the image that's given is their investors. So their whole question is, what are you going to do? What are you going to do next year, the year after? How am I going to make my money back? Lenders, which is predominantly, banks, high street banks, all of that, lots of independents. What they're looking at is what you have done.
Okay.
So they don't care what you are going to do. They want the security of knowing what have you done, and consequently we know that we're pretty secure we're going to get our money back. And dependent on the finance, depends on the criteria. So if there's an asset, like a van, actually the criteria is a little bit looser, for want of a better phrase, because they've got an asset. If you want straightforward cash, that's a little bit harder because that's all based on your business. I'm going to give you £50,000. I'm going to bank that you're going to pay me that back. Whereas with an asset, it might be I'm going to give you that van for £20,000. But actually, if it goes a bit wrong, we have got the van that we can take back, which we might be able to resell for 15. So our risk is maybe £5,000. Whereas with the loan, our risk is the whole amount. So it depends. But they will always want last 3 to 6 months bank statements and definitely accounts for the last 1 to 2 years. And generally speaking, you will get loans pre 2 years, but generally speaking, trading for 2 years. The government do a startup loan for startup businesses. So if you're brand new with nothing, the government startup loan on their website is probably where I direct them, in fairness, because that's built for them. But once you've been trading and you come out of that, I think it's after 6 months or a year, then you start to talk about commercial finance, and certainly after 2 years, that's commercial finance. Okay.
Is there anything else more, in more detail, or anything else to add there between like asset finance then and loans?
Yeah. So, what I would say is obviously the risk for companies as well is whenever they're looking at finance, it's the stages of it. So the first stage that a business will know that they need finance, let's say in a negative way, is that they will know. The second stage is that their bank statements will tell them that there's a problem. The third stage is their accounts will tell them, and then suddenly that will start to impact on the business with regards to their credit. And eventually the end of the road is actually it affects your personal credit because you start loaning against your personal assets. Lenders, if you know something's coming and you need it, the best stage is stage 1 when you know, and probably when it hits your bank statements, you'll be okay. Once it gets into your accounts, and maybe you've made a loss or there's a drop in turnover, it becomes harder because then lenders see the little red flags.
Yeah.
So, but yeah, look, there's lots of different products. You mentioned asset finance as one. That's probably one of the easier ones. All I would say on that is everyone thinks of it being vans and big bits of kit like printing machinery or engineering kit. It can be anything. It can be, they call it soft and hard assets. So a soft asset can be lighting.
Right.
So I did a deal for a communal building in Staffordshire and we funded all of the lighting throughout the communal building at about £15,000. Wow. So that's quite a hefty chunk on lighting, but he needed it for his communal building that he rents out. Asset finance, paid it back over 5 years. So, but it's rates on that are reasonably good actually.
Yeah.
So it's one of the few that have been affected. They have been affected a bit, but again, the risk is reduced because there actually is something, whether that be what they call soft, like lighting and things like that, or whether it be like a hard asset, like a big bit of kit that can't move because it's pinned to the floor and weighs a ton, or, vans or tractors or big bits of kit. So.
And then on the other side, for a business, and we can all, I'm sure we can agree, and we're familiar sometimes with this ourselves, but sometimes invoices don't get settled when they should be settled. Now, for it could be even a small business, a one-man band, or it could be quite a large business when this starts to happen, and if it's happening quite regularly, is there any options there which can help to bridge that gap at the time?
So invoice finance is a product built for that. Let's say the word factoring, because if anyone's listening and they've heard the word factoring, and I say it in that tone because they'll go, oh, it's a terrible product, it's awful. It actually isn't. It is if it's not done properly, and it is if it's not used for the right circumstances. But done correctly and done properly, actually it's really good. And so I will dispel a myth that we get all the time. Factoring's for people in trouble. No, Not at all. Not at all. The clue, unfortunately, is in the name, invoice finance. It's funding invoices. If you're in trouble, you haven't got any invoices. So you can't have them funded. What it is it's a problem because, as you say, your debtors aren't paying you. So actually, it's not your issue, it's your debtors' issue. On average, 30-day invoices, 40 to 45 days, 60-day invoices in the 70s. And if you're in the construction sector, generally longer than that. So you're doing the work on day one. You want that paid in 30 days, you might have to wait 45. And they might say, oh, my payment runs at the end of the month, and you put the invoice in on the 10th. You could be waiting 6-7 weeks for that invoice, but that's your money, your profit. So invoice finance doesn't give you any new money. It's not a loan. It doesn't give you an injection of cash, which some people will need. It purely allows you to keep growing by turning your own cash quicker. And done properly, absolutely. And I think people would be amazed at the size of businesses that will use invoice finance. I think everyone thinks it's, as you say, the one-man band turning over, maybe sub £1 million. Oh no, you'll get businesses turning over 40, 50, 60 million pounds using it. Because in the end, it's not the business that's got the problem.
Yeah.
It's the people who won't pay their invoices.
Yeah.
That is the problem. And that's why businesses of all shapes and sizes need it.
And again, without, going into names or anything like that, but over your experience, even before you started the business back in 2017, is there any particular scenario that you've come across where somebody has, getting late payments and they're at that bridge where they've been then obviously successful in getting sort of, invoice finance? Have you come across or dealt with anybody where it's been really, really bad?
Yeah, I used to work in invoice finance before I was a broker, so that is kind of my area of specialism. But yeah, I think there are some sectors, temporary recruitment will struggle without invoice finance because they have to pay their workers every week, and they're likely, even if they get paid on 30 days, very difficult to fund 4 weeks of staff. And if you want to grow and you want to put 10 staff out, 20 staff, 30 staff, 40 staff, you've got to pay their wages. You can't do it. So generally speaking, most temp recruiters will have IF, but it can be a full range of businesses. Manufacturers, I had one that made the rollers for airports.
Right.
They had it, because again, their debtors are paying them late. Big electrical contractors, flooring, I say temporary recruitment. It's the full range. Manufacturers, it's anybody realistically. It doesn't matter what their business is doing. It matters how quickly they're getting paid. And if they want to grow, they need the money quickly. And if they don't want issues with cash flow, and the other option is then you take a loan and you almost run your own cash flow, but you're paying for a loan because other people haven't paid you. It doesn't really seem fair.
It's almost this. What this reminds me of? Going completely off the scale here. But this reminds me, it's like when you go behind the scenes, even in a reality TV show, and you see, but what you explain there is just one aspect of what can go on behind the scenes in a very successful business.
Absolutely. But again, invoice finance and lots of successful businesses will have finance of some description because it's extremely difficult to run that in-house, whether that be debtors paying you late or whether it's because you don't want to rent your premises anymore, you want to buy your premises, or whether it's actually because you are a very large business and so cash injections at certain times cover a VAT bill, for example, could be one. That comes in every quarter. You're a big business. Whoa, that's going to hit our cash flow. Well, finance it over the 3 months, keep a bit of money in your bank account. And I think on that, what I'd say as well is we talk all about pound, shilling and pence.
Yeah.
And we can save money and we can do this and we can do that. Actually, there is another element. It's you sleeping at night. And actually, if you having finance in place, it's going to cost you, obviously. There's a charge to that from the lenders. There's a rate, isn't there, an APR. But if that allows you to sleep instead of going to sleep every night worrying that you haven't got the money, how are you going to pay your wages on Friday? Well, if you've got that, there's an element of that as well beyond the pound, shilling and pence that I think business owners go, do you know what? Great. Just gives me a little bit more relaxation. I don't have to worry as much every single day because I've managed to get that for my business.
Yeah. So. And then just moving on from that as well, say a business, they're in a position, they're either looking to expand, they're looking to buy a new premises or anything like that. What is the process there? Again, does it differ quite a lot from the asset finance and the invoice financing? How does it work with all of that?
So first of all, the best way to describe a commercial mortgage is exactly the same as a residential mortgage. Just slightly different nuances within that. For example, you will need to put down more cash. So generally speaking, you're looking at 30 to 25% cash that you will have to put down as a deposit. Likewise, you might be able to fund that in your business, or in actual fact, you could use another finance to fund that as well. Because you will say, well, actually, it's cost effective. There's an asset on the balance sheet, number one. And number two, actually, we're saving on the rental costs. But it works very similar to a residential mortgage. It goes to an underwriter. They say yes. They do a valuation. Great. We're happy with that. And then we go to solicitors. It's brought me out in a cold sweat.
Yeah, that's it. But what sort of, just on that though, what sort of age usually would a business be? Does it matter? Could they have been going 12 months and obviously been very successful? Or, is there a sort of a general trend, should I say, of when that would potentially happen?
I don't think there is actually, because I think, again, it's always good to throw out the word, it's easy to get it. It doesn't mean to say it's easy, but when you look at the types of commercial finance, sometimes, as I said about assets, actually commercial mortgage is asset finance in another word. The asset's a great big building or a small building. So again, you're putting in 25 to 30% of that cost, say it's 100,000. So they're funding it at 70,000. Actually, the risk is a little bit lower. So I think another thing with that is often if someone comes out of renting and they're renting at £500 or £1,000 a month and they can get a mortgage, often the mortgage provider says, well, we know you can afford it because it's cheaper than your rent. So you're actually saving money and it's more cost effective. So yeah, I'm not going to say anything's ever easy, because I always say to clients, the market will determine, that's always the first question. What rate will I get? Will I get this product? Well, actually, I don't know. I can give you a steer, but the market will determine where they pitch you, and the market changes. You know, the market coming out of COVID was probably quite good and people wanted to lend, et cetera, The market's probably not as good at the moment. I think probably lots of businesses would agree with that. And hopefully it will get a bit better in the coming months. So lenders will always mitigate their risk dependent on what they feel as well.
And just before you go, Matt, there's one last thing I just want to ask you. Is a business out there, we talked about at the beginning when you came onto Business Spotlight today about, the where a business can get overwhelmed with all the different options out there. Is there anything, and again, I don't want you obviously to name anything, but where a business should be aware of certain things or products, whether they're coming on the market or they're coming from, not even from a broker like yourself, but they could be coming from another official source? Is there things where they need to be really aware and just to really check things before they step in and go for it? Yeah,
I think in the end what I would say is business owners are great at doing their business, and often it can be a struggle to do the other things. So they might pay a marketing department. Well, it's the same with the finance. And as I said at the beginning, it can be easy to go, well, that lender sent me 27 flyers this month. They must be okay, I'll go with that. An example at the moment is the government guaranteed growth scheme that's just been launched very quickly. COVID hit, they launched CBILS, which was great for businesses. The problem was that the lender did the underwriting, so it was very slow. They realised it didn't work, so they launched the bounce back, kept it at 50 grand. Basically, put your name on a piece of paper, we'll give you £50,000. It was almost that easy for a lot of businesses. Well, obviously they've finished now, so they then got put under pressure. Well, what are you going to help businesses now? Just because COVID has stopped, in inverted commas, going into the middle of it, just because it's stopped, doesn't mean that businesses aren't struggling as we come out of that. Okay, we'll do the recovery loan scheme. And that's had 2 or 3, I think, different nuances where they've rebranded it. Well, that's now finished. And this is the next cab on the rank, for want of a better phrase. I would just be wary, because already clients have said, new loan, I've had this flyer, there's a new loan out, can we apply for that? The loan is not as it was in COVID, where it was backed by the government. If your business failed because of COVID, don't worry about it. That isn't the case anymore. These loans are very much like RLS. They are underwritten by the lender. So if we go to a lender, I had one only a couple of weeks ago, went to the lender for various reasons, couldn't get the loan amount that they wanted. Can we go the government loan? Well, no, because it's the lender will underwrite it to the same policy, and personal guarantees will almost certainly still be required. So it's not like it was in CBILS. It's changed. So it's another string to lenders' bows. It's another pot of money for them. But I don't realistically, in my experience, see it being a massive advantage for clients, because they're still going to be underwritten by the same underwriters who will underwrite the loans, the asset, the commercial mortgages.
Matt, thank you so much.
Thank you ever so much.
Thank you. That's Matt Fludgate from Gatewood Commercial Finance here on Business Spotlight with me, Sonya Farrall.
Business Spotlight, shining a light on our local business community. Brought to you by Cross Rhythms and Baba Baboon.